Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese. Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC-registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors. And we are back. By the time we're done recording, gold might be $4,000, Sonu, because it is just going up, up, and away. Welcome, everybody, back to episode 156 of Carson's Facts versus Feelings. Ryan and Sonu here. Shut down, but not out. Right. We'll see by the time people listen to this. Good chance we're still in a government shutdown. Just so everyone knows, we're recording a day earlier than normal, October 6th, 2025. Let's start with gold. Let's, sometimes we
I thought you wanted to start with the shutdown, but no.
No. I think gold's more exciting.
No, it is.
Gold is, feels like every day you look, it's up another 1% or 2%. One of these days is going to have a big pullback, but the reality is gold's flirting with $4,000 an ounce. So it wasn't that long ago, it was $2,000 an ounce. I remember that because that's when we first dipped our toe in our tactical models way back in the spring of 2023. Yep. And Omani Carson reached out to us. We were chatting on our team's message, how high you think gold could go. And I said, maybe 2,500. I thought it was a bull market. It sounded like a lot at the time.
Yes.
I didn't want to say 4,000 to come off like I'm crazy, but here we are. Let's talk about that. So gold keeps going up. How worried should we be, and why does it keep going up?
I think let's take this. I'm not too worried about it going up. It goes up for, so. And when you think about portfolios, unless you have, I just saw, I think it was Morgan Stanley, one of these big Wall Street firms, like, you should put 20% of your portfolio in gold.
Yeah.
Okay. Now right. That is too much.
Now they say it.
Now they tell us, right? I think 20%, look, this is pretty volatile. Is that take out for 20% of your fixed income and put it into gold. Come on. Yeah, I know. So Ryan's rolling his eyes, right?
Yeah.
For those of you just listening. But no, I rolled my eyes several times when I first read that. But look, gold is up 51%. Now, here's my take on historically, gold goes up when real rates go down. Yeah. Real rates, real yields. Think of that as a TIPS yield, right? What you get on Treasury inflation protected securities. But TIPS is actually kind of a new thing. Okay. It started off only in the late 90s. Gold did well in the 70s. So it's not just because of that, right? Real rates are essentially nominal rates minus inflation. And if inflation tends to be on the higher side, or if nominal rates are going down, say if the Fed is cutting rates, that's a tailwind for gold, right? Now, the other part of it is I think there's a lot of demand from foreign central banks. You and I have talked about that before. It also works as a currency diversifier for a lot of people. Like, you know what? We don't want to be quite so overexposed to the dollar. Doesn't mean that, from our perspective, it's not like we're negative on the dollar. We just don't want too much exposure to the dollar. What is the easiest way to diversify that exposure? Well, you could buy foreign equities, which means you also buy foreign currencies, but you buy gold, right? I think there are a lot of people doing that right now. And there's this debate on X or Twitter. I don't know what we're calling it. Anyway, on X over the weekend about people like, why is gold going up? And I was like, here's a counterfactual hypothetical. What would it take for gold to go down from here? I think one answer is if Powell or whoever the next Fed chair, they're not going to do this. If Powell came out and did what Paul Volcker did in 1980, 1981, raise rates, let's say they raise rates to 7 or 8%. I think that crushes gold.
Yeah.
They're not going to do that right now. I think they're doing the opposite, and that's why gold's up.
No, well said. 2022, obviously a very aggressive Fed, generational highs in inflation, stock market down 20%, bonds down double digits for the worst year for bonds since George Washington was president, and gold was about flat. Now, about flat beat most other things. We had J.C. Pretz on, when was that, 5 or 6 weeks, 7 weeks ago? Yeah. And he made the comment, and he's exactly right, if gold were to peak today, we don't think it is, but if it were to, it'd be the shortest bull market gold's ever had. Right. Usually these cycles, just in general, bull markets last a lot longer than you think. And sure enough, here we are. But at the end of the day, it is a lot of central bank buying. Obviously, when the war started, 2022, a lot of sanctions put on Russia. We don't need to get too political, but a lot of countries said, oh boy, look at this. We're just going to buy gold as a potential way to protect some of our assets, if you will.
Yep.
And they're buying. I don't know if there's too much more. Listen, we've had some gold exposure in our tactical models. We've had some gold exposure
for about 2.5 years now.
Yeah, 2.5 years. Our strategic models, longer term, we do think gold fits in a portfolio, not so much as a alternative to equities, more of an alternative to the 40% part, the fixed income side of things. Obviously, though, gold has just been amazing. I'll just put it like this. It's up 50% for the year. That's a pretty big move. All right. I went to school for that. My parents paid a lot of money for that type of analysis.
Actually, just saying on that too. Like,
let me sum it up. I was just going to say, just know that we're extremely overbought on every time frame relative to moving averages. I mean, it could be due for a well-deserved break when you got people saying, "Oh, put 20% of your money in this." Like, and we were joking. Oh, was it 2 weeks ago at your son's? Like, Dad, I want to buy some gold. Well, all gold is done has go straight up the last 2 weeks. So I guess your son, oh boy.
Well, we do have gold. No, I think our friend Warren Pies has called it the debasement trade. I mean, he's generally talking about markets, right? I think JP Morgan actually copied Warren. I think that is the direction it went to. JP Morgan recently, Warren's been talking about this for a while, the debasement trade, which at some point we'll have him again as a guest. So hopefully sooner rather than later. But he talks about it as people are more worried right now about losing purchasing power. Right. And that's why, gold has found a bid. And, that's the debasement trade, right? I think JP Morgan sort of copied that from Warren. I think that's the case. We always talk about what's the message of the market. What's the message that gold is sending, right? I think it's sending a message that inflation's a problem. It's as simple as that. I think inflation's a problem while the Fed is cutting rates. Right. I think it both have to come at the same time. It'd be one thing if inflation was really high, but the Fed was raising rates. I don't think we would see what we're seeing in gold if that was the case. But that's not happening right now.
No, I mean, the other thing that's happening, stocks are doing okay, right? Last we checked, S&P's up like 15% for the year, which is actually one of the worst performing stock markets of the year. Now, the U.S. did great the last 2 years, so it's all relative. But the truth, again, as we've laid out many times, we thought those two asset classes could do pretty well together for various reasons that we discussed on all this podcast time and time again. And fortunately, that has absolutely been playing out. Let's move forward. Let's go to the government shutdown. The reality is it doesn't famous last words, but it doesn't seem like the two sides are any closer. No. You've got the betting markets that are saying maybe 21 days for the shutdown, which means at least another 2 weeks. Now, that can change in a hurry. We're aware. I don't know. Market doesn't seem to care because literally the time we're doing this, hitting all-time highs. S&P's going to be up 7 days in a row. We had, I think it'll be, assuming we're higher this Monday, the time we're doing this, 32 all-time highs. Literally since the government shutdown, all stocks done is go up. So we've mentioned before, government shutdowns cause a lot of cause a lot of volatility in the media is what I meant to say, but markets usually take them in stride. The last one was 34 days. Stocks gained 10%. Had nothing to do with anything out of, I'm going to say Washington. It's not true. Anything out of that part of Washington, but it's because of the Fed. The Fed pivoted in late 2018, early 2019. What's the latest, Sonu, on your crystal ball on this shutdown? I guess how much we should worry because we're not getting any economic data. I know you got a lot you want to talk about here, but where do you want to go with this?
I think the lack of economic data is worrying. That's this whole separate thing.
Because that's what I joked. What are you going to do? It's not like you have a lot going on. I mean,
you should take a vacation.
You're the guy who just spends 2 hours looking at JOLTS data, which we're going to get to. I mean, you should take a vacation to take a little break with no data, Yeah.
I know. I should have planned my trip for now. Like this Christmas. Why couldn't they do this during Christmas holidays or something?
Well, they might. Hey, you know what? Don't say they're not going to do that, Sonu. Don't say the records are made to be broken. I shouldn't joke about that.
I know, exactly. Yeah. Day six of the shutdown. We're recording this on October 6th.
Okay.
The government's fiscal year ends on September 30th. So here we are, right? Look, I always thought this was going to last longer than, I think last week, markets are pricing, the betting markets, Kalshi was pricing this as a, 6 to 10 day or 15 days?
I swear I saw 10 or 11. It changes. It changes quickly. I thought it was somewhere around a week and a half.
Right. And I was like, that's too short. That's not going to happen. Okay. Because at worst, I don't know, at worst, at best, however you think about this, military service members have to get paid on October 15th.
Okay.
Right. That's kind of like a forcing function here. Right. People are like, but the last time, I forget which shutdown it is, they passed a bill saying pay our military members or something pretty much like that, right? In which case the service members got paid.
Good.
So right now, look, I don't think this was true even before the shutdown. There's no incentive for either side to give in. Usually the side that doesn't give the votes to reopen the government, usually this is on the Senate side at least, they suffer in the polls. So who's not giving the votes right now? The Democrats. They're saying, you know what, we are not, giving you 60 votes. Republicans have about 53 votes thereabouts. And Democrats want to extend the subsidies for the Affordable Care Act exchanges, right? Now that's a popular position by itself, right? And so they're not suffering in the polls yet. It's usually when one party starts to really get hit in the polls, they're like, suddenly 1, 2, 3, 4, 5, 6, 7 senators peel away from the rest of them. So the rest of the caucus and say, you know what, we're voting to reopen the government. That's when, that's how this thing gets resolved. I don't know that happens anytime soon. Maybe by the 20th or 25th or even 30th of the month. I think that's when this is going to go down for a fairly long period of time. One thing that could happen is the November 4th elections. Right. One party, either Republicans or Democrats, get a message saying, you guys suck, basically. And then they're like, okay, we got to reopen the government.
Is that a Hallmark card? I think we can sell that. Yeah.
Or maybe you guys all suck or something like that, right?
Like the front says, Dear Congress, special message. Oh, exciting. You open it up, you suck. There you go.
So I think there may be some urgency to cut a deal after that, depending on which side takes a beating, right? So whichever side it is. I mean, it's not nationwide elections. You got elections in Virginia, New Jersey. There's a mayoral election in New York, which shouldn't really matter. But now all elections are nationalized, right?
So
it's a big thing.
I think I'm doing a media trip to New York on November 5th, which was the day after the election in New York City. So that could be an interesting day to be in New York. We'll just see. We'll see how that all shakes out. But anyway.
Anyway, where it matters is we don't get any data. We didn't get claims, unemployment insurance claims data. More importantly, we didn't get payrolls data.
Yep.
Next week, we are probably, if this continues, we're not going to get inflation data either, which means the Fed, when they go into their next meeting, October 28th, 29th, they're going to be flying blind. The other thing is around the 12th of the month is the payroll survey week. In which case for October payrolls, which means I don't even know, maybe we never get October payrolls. So Trump could fire the federal government employees, a whole chunk of them, and we never know, right?
Wow.
So if you don't get the data, it's not true. So there you go. No, I'm just joking. It is true. It's just that, look, we have no visibility into this stuff.
Well, there's a lot there. Obviously, we're paying close attention to it. We're not minimizing it because it clearly impacts people. But as we've said, for several weeks now, because you saw this coming, historically, markets can take it in stride. And let's maybe talk about that F word. Let's talk about the Fed a little bit. Fed funds futures are looking at that again, October 28th, 29th, FOMC meeting at like 95% chance of a cut. You and I did a call just this morning with our Carson partners, our morning call. We had over 150 partners join us for a really fun discussion. And you shared some charts. I don't know if you have them for this, but just the truth is, again, what's the not the betting markets, the Fed funds futures. The Fed funds futures are still saying, hey, you're going to get a couple cuts this year, but more next year. I think it's 5 cuts the next 14 to 15 months is what's the bet that the market is telling us. That's more than what the dot plots were telling us a few weeks ago. What do you think about the Fed here? They are flying blind, but they're still going to cut, it looks like, right? Is that the answer?
Like the dot plot says 3 cuts between now and the end of 2026. Market's pricing in about 5 cuts, including one in October, maybe another one in December. By next year, that would take the Fed funds rate to 3%.
Yeah.
Right? That's what markets are pricing in. Doesn't mean this is actually going to happen. Markets could be wrong. At the beginning of 2024, as you and I have talked about before, markets are pricing in 7 cuts. We got only 2 or 3 last year.
Markets can be wrong. I guess I never argue with the market, but sometimes in April, when the market was doing what it did in April, we were looking at each other like, this doesn't make any sense. Markets shouldn't be down this much, and now here we are. Yeah.
I mean, put a pin in because I want to talk about tariffs too. There's some interesting stuff happening on that side.
That sounds so exciting, Sonu. This is what happens when Sonu doesn't have any data to look at. He spends all day looking at tariffs. Oh my goodness.
So anyway, cuts are being priced in. I think that's a tailwind as well. I know you got some charts. You're going to talk about momentum.
Yeah, we'll get to the market.
Coming into this quarter seasonality, but now we got rate cuts.
Let's take a break for a second. Charlie Sheen is everywhere. Like he's got this book out. I
watched
really?
I haven't seen it.
You kidding me? Oh, Sonu, I thought we were buddies. AKA Charlie Sheen on Netflix. He just did a podcast with Conan O'Brien. Anyway, I thought you'd listen. He is.
What am I doing?
You talk about like crazy. Okay, gold to 4,000. That's crazy. Okay. The fact Charlie Sheen is alive when you listen to the stuff that guy did, wow. There's some homework for you. So here you go.
Does he have a book out or what's it?
Yeah, he's got a book out. Yeah, he's got a book, and he's got a Netflix show, and he's just running around,
really? Wow.
Talking about how he's still alive, which is again shocking when you hear some of the stories. But now that's your homework. Since you don't have any economic data, just get caught up on Charlie Sheen.
Maybe I'll buy the audiobook. I have never listened to an audiobook in my life. Maybe the Charlie Sheen audiobook.
I haven't either. I mean, I listen to so many podcasts. I just love getting in my car, driving around, listening to podcasts. I don't do the audiobook thing, but anyway, all right. Well, that's that.
Now I have the mental picture, like you saying to yourself, "Oh, I need to listen to a podcast. Let me just jump into the car and drive around Cincinnati."
Yeah, when everyone's getting sick of me in my house, I have to drive around a little bit. So let's see. I've got a couple things scribbled here. Let's just do tariffs. Let's do tariffs. I mean, the call we had this morning.
Spend too much time.
No, it's all right. I mean, the call this morning was interesting. You brought up some great points, I thought, because at the start of the year, we knew President Trump. I mean, he ran on higher tariffs. So that wasn't a shock. And we said, okay, maybe 10 to 15% tariff rates will be okay. Liberation Day came. It was up over 25. That's why we had the 2-day 10% drop and everything went crazy. The 10-year yield spiked above 5%, like at midnight, whatever. I guess it was the 8th. The 8th at midnight because it bottomed the 9th. I think I got that correct. But the reality is that now the 10-year yields went closer to 4, almost down around 4. So a long way from there. That freaked the bond market out. And they said, okay, never mind. We're kidding. And the truth, though, Sonu, you looked into it. What's the real effective tariff rate? Because we can talk about effective tariff rates, but what's really happening with tariffs here when you peel back that onion?
And we got more announced tariffs, right? The president just announced, I think on 2 weeks ago, September 25th, 100% tariffs on branded pharmaceuticals, 50% tariffs on kitchen cabinets, vanities, 30% tariffs on furniture, 25. I just saw something on my Bloomberg, alert that 25% tariffs on heavy and medium-sized trucks. So there's that. So there is if you look at all the announcements, let's call it the announced average effective tariff rate. That's about 18%. Okay. Which, going back to what you said before Liberation Day, people are like, okay, if you get to 10%, tariffs are going up. So we knew that, to your point, right? At the beginning of the year, we were at around 2.5% thereabouts. Is that best case? No issues at all. We get to 10%.
Right.
We could deal with it. 15% was sort of, I think, everyone's base case. Okay, we can deal with that. 20% was the worst case. And, as you said, we went above that and then things got pulled back, blah, 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 whatever. Right. So right now, announced effective tariff rate is about 18%. But if you actually look at the amount of money the government's collecting, and they are collecting a lot, right? Yeah. They're collecting about 190 million. Through October 2nd or 3rd, the federal government collected about $190 billion in tariffs. That's about $117 billion more than the same time last year, right? That's a lot. But again, for perspective, income taxes totaled about 2.4 trillion, right? So within the context of that, 117 billion more doesn't seem like too much, but still, it's not zero. But if you take that and divide that by the total value of imports, right, you get the actual effective tariff rate. Okay. Right now, Ryan, that's sitting below 10%. That's sitting about 9.8%. That's actually slightly below the best case scenario all the analysts had in mind before Liberation Day, right? So here we are. And this is one thing where we were just talking about message of the markets with gold, right? The message of the market from the stock market back in April and May was like, you know what? They're not doing 25% tariffs, right? And here we are.
Yeah, the S&P's up 5 weeks in a row. We'll talk more markets here in a second, but 5 months. 5 months in a row. We had a historic rally off the April 9th lows, as we talked about every week on here. Again, I think the market was sniffing out. We're not seeing 25. We're not seeing 20, maybe not even 18, like you're telling me. It's somewhere less than that. So amazing how that's playing out. Anything else on tariffs you want to point out before we I think,
look, the reality is less than 50% of goods are being tariffed right now. That's because there are several exemptions. And that's essentially what's happening, right? Mexican, Canadian goods that are, that comply with the USMCA, which is a replacement for NAFTA. Those aren't tariffs. Energy products, crude oil, precious gold. Gold's not tariffed either, right? And then last week, I was going to ask you about healthcare. Kind of rebound we saw in healthcare. Part of it is driven by Pfizer getting a 3-year exemption from tariffs on pharmaceuticals. And then here's a big one. What's the biggest import coming into the U.S. right now? It's computers. I was going
to say tequila, but I guess not.
I guess not. Yeah. George Clooney is big. He's not that big, but I think he's got a tequila farm or something like that.
I think everybody does.
But, we should get one. Facts versus feelings.
Listen, I don't know if you ever knew this about me. Tequila and I don't get along. I have had tequila a handful of times in my life, and normally tequila wins.
That's actually good.
I have never been
drinking your own supply. Right?
I've had exactly drink your own supply. I've had 2 speeding tickets in my life. Never been arrested, but I'll tell you, tequila and I maybe should have been. Oh, leave it there.
Let's skip the margaritas. Maybe I'll do mezcal or something. And anyway, getting off topic. The biggest.
Yes, we did. Yeah.
Sorry. So the biggest import right now coming into the U.S., chips, computers, parts, things like that. It's simply massive. None of that stuff is being tariffed, which is interesting that none of that stuff is being tariffed. Right. But, automakers, home builders, all of them are seeing tariffs, right? This also gets to, I know we're going to talk about what's happening with mid caps versus large and small caps, right? But we'll set that aside for now. And I know when we talk markets, we'll bring it up. But anyway, that's what's happening on the tariff front.
No, the good stuff there. And maybe I'll go there. I want to read a couple things. So you can just take a break for a second. So this is a blog you put together, but just it feels like, no, it's okay. It's a good blog. It's a good blog you put together. Every day we come in the morning and there's some new AI deal. Now, this is just wild when you read it and think about it. NVIDIA had $100 billion to spend with OpenAI, and they're going to supply data center chips, as well as $5 billion with Intel. OpenAI also bought $3 billion in computing power from Oracle over 5 years. CoreWeave signed a 5-year deal with OpenAI worth $11.9 billion. Google had a 6-year cloud computing deal with Meta. I mean, these companies, I thought they were competitors. Apparently not. Over $10 billion. Amazon had a $4 billion deal with OpenAI again. Oh, I'm sorry, OpenAI competitor Anthropic. Apologies. And then we have Stargate, a joint venture between, ready for this, OpenAI, Oracle, and SoftBank, all expected to invest $500 billion in data centers. And then just this morning, on Monday, we had, OpenAI and AMD had a deal to buy billions worth of dollars of the MI450 AI chip. And that is, it also, OpenAI is going to buy about 10% of AMD, or had the rights to it. AMD stock was up over 30, not a recommendation, up over 30% this morning. I'm not sure where it was. I mean, I don't even know where I'm going with this, but these companies don't feel like competitors anymore. Every day we come in and they're all doing some big deal together. OpenAI is that one you see that's kind of the what do I want to call it? The John Stockton doing all the assists with everybody. But the truth is, and you mentioned the economy, the consumer usually makes up a lot, but you said before, I think, CapEx with AI is over 1% of GDP. The consumer is like 0.6, 0.7%. So we're seeing more growth out of CapEx with AI, and it doesn't seem to be slowing down. Last comment, I'll go to you. Back in May, when things were a lot different, joined by our buddy Dan Ives up on stage in Omaha at Partner Summit with all of our amazing Carson partners. And Dan Ives was like, no, this is coming. CapEx isn't slowing down. Just get ready, guys. And we all like, okay, yeah, Dan, you always say that. No, he couldn't be more right, because these deals aren't slowing down. So I don't even know my question to you. I'll just put the ball on the tee and let you go with it. What's your take on everything I just said?
It feels like I know you probably do more work in Excel than I do. So I'm sure you've run into this. Sometimes your formula gets messed up and it tells you it's circular.
I've never had that problem before. Oh, there's circular thing. I don't know how. I can't stand it. I have to start over. I can't even get rid of it. I'm like, what is a circular? I don't even know what it means. And I'm like Googling and looking. I'm just starting over. I hate that thing. Yeah,
right. That's what it feels like right now. It's like OpenAI, NVIDIA, Google, Meta, OpenAI again.
I mean, Google and Meta making deals. Like, they're not supposed to like each other. Google and Meta, they're buddies.
Microsoft and then OpenAI again, because Microsoft is part of OpenAI. OpenAI can buy AMD. What's interesting with this is today's deal. AMD, by the way, is up 23 or 24%.
Right
Not
now,
a recommendation,
so they
by
were
the
up
way.
over 30, but they're hanging in there. Yeah.
no, like they're up only 23, 24 now. They pulled back. But this deal is not even cash, right? They're getting warrants or something like that to buy 10% of, the chip company. So anyway, all this to say, a lot of this when people say, oh, the AI boom is coming, I'm like, the AI boom is here. It's showing up in GDP. It's showing up in the stock market. It's probably been showing up in the stock market for a while now, but it's definitely showing up in GDP. To your point, the AI-related hardware, software investment spending, when businesses spend, we call it investment. And you and I spend, we just call it spending and consumption, right? But business investment into this stuff, it's about 6% of GDP. Consumption, 68, 70% of GDP. So it's not a big part. But that contributed on average about 110 basis point, 1.1 percentage points to GDP growth over the first half of 2025.
Okay.
Slightly more than consumption. And GDP was revised, consumption was revised up. Even after the upward revision, investment spending on this stuff was more than that, right? So yeah, this is the big deal, already. We don't have to wait for it. So now the question is, how long does it continue? And I think I pulled up the blog. I'm glad you mentioned it. This is what Mark Zuckerberg said, right?
Yes.
If we end up misspending a couple of $100 billion, okay, I think that is going to be very unfortunate, obviously. Okay, I'm glad he recognizes that. But what I'd say is I actually think the risk is higher on the other side.
Right.
If you build too slowly and then super intelligence is possible in 3 years, but you built it out assuming it would be there in 5 years, then you're just out of position on what I think is going to be the most important technology that enables new products and innovation and value creation in history, right? Larry Page over at Google, he says, I'm willing to go bankrupt rather than lose this race. Everybody's focused on ROI, return on investment, but the people making the decisions are not. So you tell me, or maybe the audience can put this in the comments, do you think this continues or not? I think this continues.
Yeah, I'll tell you, boy, you hear some of the talk like that, the contrarian in me worries a little bit. Like, this feels a little over the top. But that's a great point. On the YouTube channel, please do us a favor. Like, if you're watching this now, give us some comments, right? Give us comments, give us a review, give us a like, give us a follow. That stuff does great for the algorithms. And on YouTube specifically, we can have comments open on there. So please feel free and do that. Anything else on that, Sonu? I mean, it just...
I think a lot of our work is going for the outlook next year is going to be like riding the wave. You ride the wave and then you protect yourself, right?
I like that. Ride the wave.
You have to protect yourself because this can't keep continuing. At some point, it will end. And I'm going to be very careful in saying, do I think this is a bubble or not? It doesn't matter, right? I'm going to be investing in it. We're slightly overweight technology, right? But we are also well diversified. We have gold. We have all these things in there.
Yeah, no, well said. Let's go that route. We'll start talking markets here. So we know large cap tech, it feels like, just keeps going up because of the deals we talked about. Small caps have done very, very well also. It's like this barbelled approach. Then there's somebody in the middle, the Jan Brady of the world, the mid caps. And you and I discussed this morning with our Carson partners, but the truth is, and I was kind of surprised, like maybe you were to a degree also, mid caps are like being left in the dust all of a sudden. I don't know if I've ever seen relative. It's relative. I mean, it's relative. You're right. It's relative. I don't know. Usually we call it SMID, right? Small and mid. They tend to kind of trade together. Not so much. I don't know if I know why, but do you have any thoughts on what's up with SMID? Why it's being left in the dust?
Hey, we speculate, so I'm going to speculate.
There you go. Let's do it.
That's our job. It's tough. No, look, actually, mid caps are my favorite asset class. Like historically, say like, what would you pick for the next, say if you had a big bull market for the next 3, 4, 5 years, even decade, like, or if you're investing for the long run, like our friend, Professor Jeremy Siegel said, I think mid caps have historically outperformed, right?
Yeah.
Large and small. I think it's a forgotten asset class because everyone's go ahead.
That's why I call it the Jan Brady, because again, it's just kind of like there. It's kind of like, everyone's looking at her, everyone's looking at him. No one ever looks at mid caps. And I like that too. I mean, trust me, I'm still thinking about the comments made by some of the large tech leaders. Like, I'm not saying it's reckless, but it feels like, wow.
It makes you a little queasy, right? Little butterflies in the stomach, especially because now 50% of the S&P 500 is in this stuff, right? It's, it's tech adjacent. Even the utility stuff is
utilities. Utilities are all about. Oh, by the way, last week with Jan Van Eck, CEO over at Van Eck, we discussed that very thing, electricity and all the things that are coming from that. And that we had a lot of positive comments. A lot of our Carson partners reached out and said they really liked that one. So hopefully you like that. We had some good downloads and listens on that one. So thanks again to Jan for joining us last week on Facts versus Feelings. Go ahead.
That was a lot of fun. So you have this barbell. On one side, you have large caps, mega caps, really, with the AI play. We know what that is. We just talked about that. On the other side, what is happening is that we talk about rate cuts, right? Who benefits a lot from rate cuts? Who borrows a lot, right? That tends to be smaller companies, right? So I think you're seeing that rally. I don't think it's on the back of, earnings are going to improve a lot. I think it's just valuation. It's, rates are coming down. That's good for small caps. Let's go buy the sector with the highest beta to that, right? Highest exposure to that. Mid caps, I think, are sort of forgotten, but also I think mid caps are probably getting hit because of economic uncertainty and tariffs and things like that. You look at ISM PMI data, you look at all the comments, tariffs are hurting, steel and aluminum tariffs are going through the supply chains, services prices are going up, input prices, right? This is not just on the manufacturing side, but even on the services side. I think that hits mid-cap companies. Large cap companies are, they have market share. They have strong moats. They get over it. They can push higher prices to customers. Margins improve. We've seen that with S&P 500 margins. I think mid-cap's another story. I think there's a little bit of a struggle there. I think there's a struggle on the small cap side. It's not like small companies are doing great, but the outlook looks much better, right? And everything's relative because of, what's happening with rates, things like that. Anyway,
I think we talked about this. Yeah, no, it's great stuff. I think we talked about this 2 weeks ago, but with small caps, there are kind of two worlds or two parts of it. There's the S&P 600, which are companies that have profits, that actually make money. The Russell 2000, which, by the way, doesn't have 2,000 stocks. It's got a lot, but not 2,000. Those are up even more because that's hit all-time highs. The 600 has not. It's like 5 or 6% away. And again, those are more the speculative names that, again, should benefit from the cost of capital going down, specifically lower interest rates. When you're higher, when you hit an all-time high.
Good news for Q4.
Good news for Q4. When you hit an all-time high in September and October, August and September, like we did, usually not strong months, but listen, they were strong this time, we know. And then you hit an all-time high in October, like we have. The fourth quarter has been higher 7 out of 7 times, up 6.8% on average versus the average fourth quarter, which is still the strongest quarter, of 4.2%. When you're up 10% for the year, Sonu, going into the fourth quarter, like we were this year, the last 15 times that's happened, the fourth quarter's been higher, 14 of them. So that's pretty good news. When you hit an all-time high in the month of September, the fourth quarter's been higher 20 out of 22 times. Looking at September, we had a really, really solid September. Up over 3%, I think, when it was all said and done. That was one of the top 15 Septembers of all time. Looking at the top 15 Septembers of all time, what happens in the fourth quarter? The answer is higher 13 out of those times. And the top 8 Septembers of all time, this one was not, but again, just a big move in September. The fourth quarter's been higher 8 out of 8 times when you have that scenario. And I'll leave with this one. I've mentioned it a couple times. I think it's still pretty good stuff, so we're going to talk about it again. When the S&P 500 is up 5 months in a row, like it is right now, or like we just are, we just had a 5-month win streak. A year later, the S&P 500 is higher 29 out of 31 times with like a 13 or 14% average return. We had a 5-month win streak this time exactly a year ago. I cited that stat back then and said, we probably see a better than average return. We gained 16%. All right. And in the middle of that, had a bear market in March and April, and tech names are crushed and stocks are down 30, 40%. Yet here we are. So I think momentum's a beautiful thing. I just listed a bunch of stats and things, and there's more to it than just that. The economy, earnings, all the stuff, but we talked about it. More of a dovish Fed. The fourth quarter still is set up, in our opinion, for strength. I will say with a lot of those names and stats I just listed, a lot of the time you actually didn't have great October performance. Not a shock. October is volatile. You just had a heck of a run. We're up 5 months in a row. Okay. I to be honest, I wouldn't mind if we're down this October. That'd be okay. And then you probably get that strength. So maybe a little volatility in October. Maybe the government needs to open back up because stocks apparently love a shutdown. So we need to open the government up and then we can have a sell-off. That's half a joke. Maybe
there could be volatility around that. Like, let's say they open it November 4th or whenever. November 5th, they open up. And suddenly we get a whole bunch of economic data.
Yeah.
right? And that, it's
you'll
like
be so happy.
craziness.
You'll be so happy. You'll be like, oh, look at all this data. Oh, you're so happy. I'm like, anyway,
okay,
yeah.
I gotta tell my wife, like, honey, I'm taking a holiday from you and the kids for like 2 days.
Just to dive into this JOLTS data that I've been so missing.
Yes. So, no, look, momentum begets momentum.
Mm-hmm.
We have that. I think that's an obvious tailwind for Q4. Seasonality already is pretty strong, right? In Q4, right? That's good. And probably into January too. I mean, you could tell me more about January seasonality. And then we have rate cuts. We just talked about the Fed and things like that. And I think, look, this seems like it's going to continue into 2026 as well. What happens in 2026? January, February, March, a lot of people are going to get bigger refunds because of tax cuts, right? Tax deductions for tips. Seniors get a deduction on a chunk of their income. You know, people get higher deductions for state and local property taxes, state income taxes, things like that. So there's going to be more money in the system in Q1 of next year. There's less uncertainty about tariff policy. I mean, maybe, hopefully, I think so, right? Yeah. More rate cuts, and that's why small caps are already rallying in response. And I think we need more AI spending because, as Larry Page said, looks like they're willing to go bankrupt.
That's quite a statement.
And then we have global reflation, more spending in places like Germany and China. And I think this is a setup for inflationary growth. It's not like inflation's running really low.
Right.
Inflation's still pretty high. And not just in goods. We talk about like services PMI price data showed that, services prices are elevated, right? Mm-hmm. So I think inflationary growth is good for the stock market. It's good for profits. It's good for margins. I think this rally continues, Ryan, into the fourth year of the bull market.
Mm-hmm. Which, by the way, that's true. This Sunday is the third year of the bull market. We'll talk more about that next week on the 12th, October 12th, 2022. I started with Carson Group. Market went straight down for like 4 months. I said, what a terrible time to start a new job as a market strategist. Market just getting killed. But fortunately, we've come a long way. I will say, though, one thing that worries me, hey, we're up 5 months in a row. I'm not saying it's a worry. Just reality is, listen, we're one of these months are going to be down. But put to call ratios, Jeff DeGraff over at RenMac did some cool work on this. Just various put to call ratios are showing kind of a high amount of optimism, right, in the options market. That could be a contrarian signal that we're due for a little break. There's a rumor I'm going to have, I think 10 o'clock in the morning Eastern time, I'm going to have coffee, breakfast, brunch, whatever you want to call it, with Jeff here in Cincinnati. Nice. So I'll get to ask him about that. And
that would be awesome.
I'm hoping to do a Spaces with him. I'll just pull my phone out and say, Jeff, let's do it. And we'll see if he does. But anyway, so Jeff's got some cool work on that. He's been very, very right. He said, hey, just something to think about. Options market's pretty optimistic. So what's your time frame like? You have 5 minutes or what?
I have 5 minutes. We can go 5 minutes. Yeah.
All right. Okay. Well,
kids can stay in school longer.
No, we don't need that. We don't need that. I'll be quick on this. Earnings season is almost upon us. We'll talk more about that over the coming weeks. Just know that historically what happens, like the quarter you're in, the how do I put it, Sonu? Let's see here. I'm tired. I'm tired of talking. Estimates for the upcoming quarter historically go down a little bit, right? The quarter before. So like right now, third quarter estimates, okay? They've actually gone up since the end of June, which is not how it normally works. And just know that's kind of rare, but companies are actually saying better things. The last time we saw something like this was the fourth quarter of 2021. I don't know if you call it lowballing it. I don't know if companies play this game or analysts play that game.
Sandbagging.
Yeah, sandbag. But normally you see estimates come down a little bit right before earnings season kicks off. That has not been the case this time. 6 out of 11 sectors have actually increased their estimates for earnings in the third quarter over the last couple months, which again is potentially a positive sign. I just wanted to point that out. And then, do you want to finish up with JOLTS, ADP, labor market? That's the only other thing on my list that I said we wanted to talk about, or something else you wanted to touch on?
No, we can wrap with that because we didn't get payrolls. So what do? You look at what data is available, right?
Right.
And we already talked about the Fed. Why do we think the Fed is going to cut? Because I think, status quo is the labor market doesn't look great. Hiring is weak. Right. And the last piece of official data we got was the job opening and labor turnover survey for August. That's only, by the way, that's for the entire month of August. And you think, oh, wait, that's really far back. We should have gotten September payrolls. But remember, September payrolls would have been collected around September 12th. So the JOLTS data from August is not that lagged, right? It's 2 weeks thereabouts. And the story is the same. Hiring's weak. David, you can put this chart up showing JOLTS non-farm hires. The higher rate fell to 3.2%. This is hires as a percentage of the workforce. That is the lowest we've seen post-COVID. It's the weakest outside of COVID. It's the weakest we've seen since 2013. For perspective, in 2019, the hire rate was 3.9%. And last year, it looked like hires were stabilizing, but over the summer, since June, July, August, it's been getting worse, right? By the way, this payrolls give you net hiring, right? Hiring net of separations, quits and layoffs. But this is gross hiring, right? How many people are being hired? In August, about 5 million people got hired. Now,
something about gross hiring. Like, I don't know. I hear that. Like, gross hiring. You know, who you're hiring here? Gross. I don't know how. Anyway. Yeah. Okay.
I'll set that aside.
Yeah, leave that aside.
Yeah. But the other thing is, you look at quits as well. Quits fell. When do people quit their job? If they think they can find another job pretty easily. Right. And that's what was happening in 2022, 2021, even in 2023. I mean, I guess you did the same too, right?
Three years ago. 3 years ago.
3 years ago, right?
Thank God I did.
Yes, there you go. Yeah, you and me both. But no, look, the quit rate fell from 2% to 1.9%. That is the lowest rate in this post-COVID era. Right. In 2018, 2019, the average is about 2.3%. Like I said, a strong quit rate. If more people are quitting their jobs and going over to a new place, that's a sign of a strong labor market. Whereas if quit rates go down, that means, it's not as easy to find a job, right? So that also tells us hiring is weak. But the good news is layoffs are actually low. And, David, we can put this chart up on layoffs. Layoffs totaled about 1.7 million in August. Okay. Now you think, that's a big number. But before the pandemic, by the way, when the labor force is smaller, it was about 1.8, 1.9 million a month. Right? The layoff rate. So you normalize it by percent of workforce. Yep. That was 1.1%. Before the pandemic, it was 1.2, 1.3%. Same consistent story that we were getting from initial claims for unemployment benefits, right? We didn't see a lot of them, right? That means layoffs are low. And I think that's a story. We are in a weak hiring, but low firing economy.
Yeah, I said it's something for everybody because layoffs down 3.5%, quits down 2.5%, hires down 2.2%. There's something for everybody. The bottom line, we do know the labor market is weakening. Is it cracking? A little bit here or there. We like our initial jobless claims for that huge spike up a couple weeks ago. Some fraud potentially coming out of Texas. It came back just as quickly, but still the labor market has issues. That's probably why the Fed needs to cut. It is Halloween season, Sonu. I put my Halloween lights up yesterday. It took about 4 or 5 hours. It looks pretty good.
You didn't burn yourself or
then it rained, and every time it rains my lights always burn out. Like, it hadn't rained forever in Cincinnati, and it literally rained the very next day. So then at the lunch, I got my hair cut on the YouTube channel. Let me know.
Nice.
Give a comment. How does my hair look? Go look at I was on TV somewhere last week. Go look at it. Let me know what you think. I went to Lowe's, got a couple extra things. I'll take a picture here once I get it all set up. I'm not the Griswolds, but I get into my Halloween decorations pretty much. You
need to come and do mine. Well, you are coming here next week, so maybe you can help me out with mine.
So I'm not doing work for you when I come visit you. We just eat. We eat. I fly to Spokane, Washington tomorrow to meet with one of our amazing Carson partners. I'm on planes for like 8.5 hours tomorrow. So I've got some day job work stuff. But I downloaded some scary movies. It's October. On planes all day. I want to watch some scary movies.
It's not the Charlie Sheen Netflix thing, right?
It's scary. Just the fact is, some of it's scary. Like, oh my God, he really did that. You don't really like scary movies, so do you?
No, I'm terrified of scary movies. Yeah, I don't watch scary movies.
You just dive into economic data, the government data. That's pretty scary for a lot of us.
Yeah,
that is. Yeah. Anything else you want to talk about, Sonu, before we wrap up here?
We did get the ADP data. Should we talk about ADP real quick, or nobody cares? I don't usually care about ADP.
I think no one cares, but I know if you don't get to do it, you're not going to be happy. So, go ahead. Take 90 seconds. 90 seconds. Tell us what it said.
Yeah, ADP, same thing, right? 3 months out of the last 4 negative jobs created. The economy lost jobs. Negative 32,000 jobs in September. Last 6 months. That's why. Look, ADP doesn't closely follow payrolls. I mean, in fact, we're always laughing about how ADP is wrong.
Always opposite. Yeah, always.
But last 6 months, you look at the general trend and, that gives you a picture. Last 6 months, April through August, ADP says the economy created 23,000 jobs on average. The prior 6 months, October of last year through March of this year, the economy created 170,000 jobs on average, right? That is a big drop. Same thing. Yeah. Hiring is weak, right? And even if you look at Challenger or there's this new data provider. I think they've been around for a while, but now everyone's focused on that. They track LinkedIn profiles. This is Revelio Labs. The data looks a little better, but even then, it's not the data doesn't look that great with respect to hiring. So same story, low hiring, low firing economy. That means the Fed is going to cut.
Mm-hmm. Yeah, that's a good way to sum it up. You got to go pick the kids up, right? So
yes.
Yeah, well, we're good. Well, listen, this again was episode 156 of Carson's Facts versus Feelings. Slow down, but not out. Or shutdown. Apologies. Shutdown, but not out. Thanks to David, our
we could have called it
producer.
Showdown, but not Slowdown.
Yeah, that's a good one too.
Or Shutdown, but not slow. See, I'm getting confused.
A lot of angles on it. It is. Usually we do this on Tuesday morning. It's been a busy Monday, so hopefully this all made sense. But listen, thank you to everybody. We had a couple of little lulls there with some of our downloads and views, but it seems like we're back. We kind of learned a few lessons there, but our last couple have been right back. So thank you to all the continued listeners, and feel free and give some comments on the YouTube channel. Give us help us there. But with all that, yes, Sonu, I do see you next week. I know I'll talk to you way before then. But to all the listeners, everybody, thank you so much. We'll be back next week with another, I call it live. It's not live, but another real-time edition of Facts versus Feelings. Have a great week. Enjoy the spooky season. Watch some scary movies. Let us know in the comments your favorite scary movie. We'll see everybody then. Take care. Bye-bye. Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.